Hello everyone, welcome to EduTap and welcome to the Finance 360-degree session. So in today's session, we are going to discuss three very important RBI notifications. Okay, the first one is regarding the qualifying asset criteria that has been changed for the NBFC microfinance institutions. So we are going to understand that what is this change that has happened in the qualifying asset, what is the change in the definition, or what is the change in the criteria that has come. Okay, the next notification is regarding the non-achievement of the PSL targets. So what is the update that the RBI has brought in this non-achievement of PSL targets? What happens if the banks are not able to achieve their priority sector lending targets? Okay, so we are going to discuss this news article, as well as we will discuss that what are the ranges that the RBI has determined. So that also we are going to discuss from the priority sector lending guidelines. Okay, next is the large exposure framework. First we will understand about the large exposure, then we will discuss about the amendment that has happened in this large exposure framework. So these three news articles or these three notifications of the Reserve Bank of India are very, very important from the examination perspective, from the objective part of the examination, and we are going to discuss these three and the important data points. Okay, so let's get started. Give me a thumbs up if everything is fine, if I'm clearly audible and visible clearly, and let's start with the session. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so let's get started. Okay, I am getting thumbs up, that means everything is good, everything is fine. Okay, so let's get started. Okay, so here the first news article or the first notification that we are going to discuss is about the non-achievement of the priority sector lending targets. So this is for the primary urban cooperative banks other than salary earner banks. So salary earner banks, they are the very small urban cooperative banks that are just constituted or that are established by just the salary earners. Some of the like government employees or some of the workers, they have come together, some of the salary earners, they have come together to establish an institution. Okay, so that is salary earner bank. Now salary earner bank, they do not have to follow the priority sector lending targets. Okay, so that's why this non-achievement of PSL targets, this is only for the primary urban cooperative banks other than salary earner banks. I hope this is very much clear. Always the applicability is very, very important from the examination point of view. Now starting with the, first of all, we have to discuss the large exposure or the limit of exposure to single and group borrowers or parties. So see, when the urban cooperative banks are giving loans or they are investing in a particular entity, let's say the urban cooperative bank is giving loan to the XYZ entity, or the UCB, the urban cooperative bank is also investing in this XYZ entity. Now, if the urban cooperative bank is giving a lot of loans to this XYZ entity, so there can be concentration risk that can arise. There can be concentration risk that can arise because a lot of loan has been given to this entity, and if this entity fails, that will affect the urban cooperative bank very badly, and if the urban cooperative bank fails, that will affect the whole of the financial system of the country, because many of the banks are linked with another bank. Okay, so the limit on exposure, so it has been said that the urban cooperative banks, they should limit their exposure to a single borrower, to a single entity, or a group entity, or the group borrower. Group borrower means, let's say this XYZ, let's say Reliance Industries. Okay, it has Geo Financial, it has Reliance Telecom, it has Reliance Power. So these are the group entities that are linked together, or they are belonging to a single group. Okay, or they belong to a group. So XYZ, let's say XYZ belongs to a group of ABC, FYZ and such. Okay, so these entities are belonging to a group. So the limit should be on a single borrower as well as on the group borrower. On a group also there should be a limit, because if XYZ is failing, ABC will be under distress and the FYZ will be also under distress. So if these entities are under distress, so all the loans that have been given to these entities will be affected, and the urban cooperative bank that has given loan to these entities will be affected. Okay, so there should be limit on the exposure on the loan and investment that a urban cooperative bank is doing to a single borrower or the group borrowers. And large exposures and revision, so there is the revision, there is the limit that should be on the large exposures, and there is revision that has happened in the target and such also, that we are going to discuss. So first of all, the prudential exposure limits for urban cooperative bank for a single borrower is 15% of tier 1 capital. That means for the urban cooperative bank, if the urban cooperative bank is giving multiple loans or the investment is being done in a single entity, so the limit is 15%. So the limit is 15%. Okay. So this is for the single entity, that this is the exposure limit for the single borrower, 15% of the tier 1 capital. And if the UCB is giving the loans and is doing the investment in the group entities in the group, so the percentage of the limit is 25% of the tier 1 capital. So this is the prudential exposure limit, that how much exposure a urban cooperative bank can have on a single borrower or a group of borrowers, so that is limited. Okay. So for the single borrower or single entity or the single party, the limit is 15% of the tier 1 capital. For the group of connected borrowers or for the group of connected parties, the limit is 25% of tier 1 capital. So this is the limit on the large. So this is the limit on the large exposure. Okay. Is there any confusion here? Is there any confusion? So this is the idea. Prudential exposure limits have been determined by the Reserve Bank of India. So in 2005, the limits were 15% for the single entity and 40% for the group entities. But later on, it was changed to 15% for a single entity and 25% for the connected entities of the tier 1 capital, Okay. So this is the idea. So now the limit is 15% for the single entity and 25% for the group entities of the tier 1 capital. The percentage is of the tier 1 capital. Okay. Tier 1 capital is the most liquid capital. It is the most liquid capital that is present with the lagging. So tier 1 capital is the most liquid capital that is present with the bank, that the bank can use in the distress kind of situation. That is the tier 1 capital, the most liquid capital of the bank. Now coming to the non-achievement. Now what happens if the bank, if the primary urban cooperative bank is not able to achieve the priority sector lending target? So what happens if there is non-achievement of the PSL target? So in the PSL, in the priority sector lending guidelines, there is the guidelines that have been given that if there is non-achievement of the priority sector lending target, so what happens? So all the banks excluding urban cooperative banks that are in the all-inclusive direction. How many of you know about the all-inclusive directions? So all-inclusive directions are the directions of the Reserve Bank of India. If the RBI thinks that a urban cooperative bank is very weak, the financial fundamentals of this urban cooperative bank is very, very weak, and there is financial weakening that is happening of this urban cooperative bank, then the RBI can bring this urban cooperative bank into the all-inclusive directions, where there will be major restrictions that will be imposed on this urban cooperative bank, on the deposits of the urban cooperative bank, on the lending of the urban cooperative bank and such. So you can understand that if a urban cooperative bank is coming under the all-inclusive direction, that means that urban cooperative bank is restricted in its functioning. Okay. It is lagging. Now is it fine? Now is it fine? Or is it still lagging? Just tell me if it is fine or is it still lagging. Okay. So urban cooperative banks, if they are brought in the all-inclusive directions, that means they are restricted. Okay. That means they are restricted to an extent. So see, all the banks, the scheduled commercial banks, the urban cooperative banks, the small finance banks, excluding the urban cooperative banks under all inclusive directions because they are restricted by the RBI. So all the banks, even including the urban cooperative banks that are other than included in the all-inclusive directions. So all the banks reporting shortfall in the priority sector lending against the prescribed target or sub-target shall be allocated the amounts for contribution that they have to do in the RIDF, that is the Rural Infrastructure Development Fund, and the other funds with NABARD, National Housing Bank, SEBI, Mudra Limited. Okay, so basically, if a bank is unable to complete its target, if the bank is unable to complete its priority sector lending target or the sub target, the bank is unable to complete. So in this case, let's say the target for the bank is 40% of the priority sector lending the bank has to do, but the bank is only able to achieve 38% of the priority sector lending. So the contribution, the bank, as it is unable to meet the target, so the bank will have to do the contribution in the funds that are under the NABARD, or that is under the NHB, or that is under the SEBI or Mudra. Okay, and the bank has to do the contribution in the RIDF. So this is the idea, that if the bank is not able to achieve the priority sector lending target or sub target, the bank has to do the contribution in the fund. Now the interest rates that is payable to banks for their contribution to the RIDF and other funds under the NABARD, NHB, SEBI and such. So this is the rates or interest rate that the bank will get. If the shortfall in the overall priority sector lending target is less than 5 percentage points, then the deposit rate or interest rate that the bank will be receiving is the bank rate minus 2 percentage points. So bank rate currently is 5.75%, minus 2 percentage points means 2%. So the bank will be getting the interest of 3.75%. Okay, if the shortfall in the priority sector lending is as huge as 5% and above but less than 10 percentage points, so the bank will be receiving the interest rate on its contribution to the funds at bank rate minus 3 percentage point. If the shortfall in the overall priority sector lending target, if the bank is having a huge shortfall in the priority sector lending target and the bank is not able to achieve that target, so that means the shortfall in overall priority sector lending target is 10 percentage points and above. So that much is the shortfall. The huge shortfall is there. So the deposit rate or the interest rate that the bank will be receiving will be bank rate minus 4 percentage points. So this is the basic idea. Further, in case of no shortfall in the overall PSL target, that means overall PSL target of 40%, let's say it is achieved, but there is a shortfall in a sub target. So then also the contribution has to be made to the fund, and in the case there is shortfall in any sub target, the interest rate of bank rate minus 2 percentage points will apply, and that much interest rate will be given to the bank. Okay, so this is the idea. So yes, you have to remember this also, because this is under the priority sector lending guidelines. So a question can come from this for the NABARD students also, for the RBI students also. Okay, on a review it has been decided. Now what has happened, that on a review it has been decided that the contribution by the urban cooperative banks towards the eligible funds under the NABARD, NHB, SEBI, Mudra Limited or any other entity specified by RBI on account of shortfall in PSL targets will not be counted in the exposure limit of the urban cooperative bank. So what is the meaning of this? Try to understand that. Let's say the urban cooperative bank is having a shortfall in the priority sector lending. So urban cooperative bank will do the contribution in the fund that is under the NABARD, or that is under the NHB, or that is under the SEBI or the Mudra and such. So the urban cooperative bank has done the contribution to a fund under any of this entity. Let's take the example of NHB. Okay, there is a fund under the NHB. So in that, the urban cooperative bank has done the contribution. Now, before, what was happening, that this kind of contribution that the urban cooperative bank was doing, this contribution was considered an exposure that the urban cooperative bank is having in the NHB, in the National Housing Bank. Okay, so this was considered exposure. So let's say the contribution is around like 3% of the tier 1 capital. Okay, and now the urban cooperative bank in a single entity, it has been said that the urban cooperative bank can only have the exposure of 15%. In a single entity, the urban cooperative bank can only have the exposure of 15% of the tier 1 capital. So 3% exposure is already calculated by doing the contribution in the fund. So now only 12% of exposure the urban cooperative bank can have in the NHB. So this was limiting the exposure that the urban cooperative bank can have in the NHB. Or let's say that urban cooperative bank is doing the contribution to the fund of the NHB for shortfall in the PSL, and this contribution is 13% of the tier 1 capital. So now you can see that now the urban cooperative bank will only be able to do 2% more exposure or 2% of the lending or the investment in the NHB. So this was limiting the money that was going to the major institutions that like NABARD, NHB and such, because there was the limitation that is 15% is the limit on a single entity for the urban cooperative bank. This much exposure is the limit, and the contribution of the NHB, the contribution of the UCBs, urban cooperative bank in these NHB, NABARD, and this was considered the exposure of the UCB. Okay, this was considered the exposure, okay, for the UCB. But now it has been said that the contribution by the urban cooperative banks, the contribution that the urban cooperative banks are doing, to the entities, the contribution the urban cooperative banks are doing in the funds of these entities. So this contribution will not be considered the exposure of the urban cooperative bank. So now this contribution that the urban cooperative bank has done to this fund of the NHB, this will not be considered the exposure. So now the 13% of the tier 1 capital has been contributed to the NHB, and the urban cooperative bank can give 15% more to the NHB, because that is the single borrower limit, right? So more exposure can happen. So this is the idea. Any confusion here? So on a review, it has been decided that the contribution by UCBs towards eligible funds with the NABARD, NHB, SEBI and such, or any other entity specified by the RBI on account of shortfall in PSL, if the contribution is happening to these funds, they shall not be included while computing the aggregate exposure of a UCB to such counterparties for the purpose of deciding the above prudential exposure limit. So this will not be counted in the exposure, and that's why there will be more chances of the UCB giving more or doing more of the exposure to these entities. So if the more of the exposure is happening to these entities, that means more of the funds will go to the specified areas like agriculture from the NABARD, the small industries from the SEBI, housing areas from the NHB and such. Next is, it is further clarified that contribution by the urban cooperative banks towards above eligible funds on account of shortfall in the PSL targets. Now try to understand this, that if the urban cooperative banks are contributing, to the funds of any of these institutions, so these funds will be taken at 100% of the risk weight. So there will be 100% of the risk weight. That means if the contribution is of 100 crore, so 100% is the risk weight, 100% is the risk weight attached to this contribution that is going to the institutions. Okay, so if the contribution is done by a bank, if the contribution is done by the urban cooperative bank in any of the funds with any of the institutions like NABARD, NHB and such, 100% of risk weight will be calculated and the capital will be kept against this risk weight. This is the idea. Okay, so it is further clarified that contribution by urban cooperative banks towards above eligible funds on account of shortfall in the PSL target shall fall under the category of all other assets attracting a risk weight of 100%. And you know that for the urban cooperative banks, the tier 1 urban cooperative bank, that are the small urban cooperative bank, they have to maintain 9%, minimum 9% of the capital to risk weighted asset ratio against their risk weighted asset. So against the risk weighted asset, the tier 1 urban cooperative banks have to keep the capital against the risk weighted asset ratio of 9%. Okay, while the tier 2 to tier 4 urban cooperative banks, they have to keep like 12% of the capital against the risk weighted asset. So the risk weight that will be attributed to this contribution by the urban cooperative bank will be 100% of the risk weight. Okay, so tier 2 to tier 4 UCB shall maintain a minimum capital to risk weighted asset ratio of 12%. So against the risk weighted assets, the capital has to be maintained at 9% for the tier 1 UCBs. For tier 2 to tier 4 UCBs, against the risk weighted asset, the capital has to be maintained at 12%. Okay, So, and this 12% of the CRAR has to be maintained by March 31st, 2026. This is the idea. Any confusion? So, tier 1, tier 2 to tier 4 UCBs, they have to maintain the capital against the risk weighted asset. The asset of the bank is the loans that the bank is giving, the investment that the bank is doing, the exposure that the bank is doing. So that is the asset of the bank, because on the loans the bank is earning the interest, on the investment the bank is earning the returns. Okay, so the asset is the loans or the investment that the bank has, the urban cooperative bank has. So risk weight is given to all the assets, because loans, they have some risk, the investment also has some risk, so that's why the risk weight is given. Now the contribution that the urban cooperative bank is doing in the funds, now this contribution is given the risk weight of 100%. So against this risk weighted asset, the capital has to be maintained by the urban cooperative banks. Okay, so this is a kind of problem for the urban cooperative bank, because they will have to maintain more capital with themselves that they do not want to maintain usually. So this is the idea. Clear? Next, coming to the next article. So here, large exposures framework, in terms of which, now this large exposure framework is for the scheduled commercial banks. So we have discussed about the urban cooperative banks, that what is happening to the urban cooperative banks, their contribution to the funds will not be calculated in the exposure limit of the urban cooperative bank, but they will have to maintain the risk weight of, they will have to maintain the capital against the contribution with the risk weight of 100%. Okay, now coming to the large exposure framework. Before understanding the amendment, let's understand the large exposure framework. This is first of all applicable on all the scheduled commercial bank, excluding the regional rural bank. So under the large exposure framework, the large exposure, what is the meaning of large exposure? This has been identified for the scheduled commercial bank. So large exposure means that sum of all the exposure value of a bank to a counterparty or a group of connected counterparties as a large exposure will be calculated if it is equal to or above 10% of the tier 1 capital. That means for a bank, large exposure is what? For a scheduled commercial bank, the large exposure is that exposure that is equal to or above 10% of the tier 1 capital. This is considered large exposure. So if the scheduled commercial bank is giving the loan or is doing the investment in an entity of 10% or more than 10% of tier 1 capital, that will be considered the large exposure. Now there is limit on the large exposure. Okay, for the scheduled commercial bank, for the single counterparty, let's say the scheduled commercial bank is investing or is providing loan to a single counterparty. So the sum of all the exposure values of a bank to a single counterparty must not be higher than 20% of the bank's tier 1 capital. And in exceptional cases, if the board of the bank agrees, then 5% additional can be allowed of the tier 1 capital. That's it. For the group of connected counterparties, the sum of all the exposure values of a scheduled commercial bank to a group of connected counterparties must not be higher than 25% of the tier 1 capital. So this is the definition of large exposure, and the limits of the large exposure is this. So the definition of large exposure is that if the exposure is equal to or more than 10% of tier 1 capital, that means it is a large exposure. Limit of the large exposure is that to a single counterparty, 20% of the tier 1 capital. In the exceptional cases, 25% of the tier 1 capital, because additional 5% can be given. 5% of the exposure can be given to the single counterparty. In the groups of connected counterparty, not higher than 25%. This is the limit, not higher than 25% of the tier 1 capital. Okay, so this is the idea. Now coming to the amendment that has happened. So large exposure. So for the scheduled commercial banks, it was said that if they have the shortfall, in the priority sector lending, so they will have to do the contribution to the funds under the NABARD, NHB, SEBI and Mudra and such. Okay, so if the scheduled commercial bank is doing the contribution for the shortfall in the priority sector lending to the NABARD, so it will not be calculated in the exposure limit of the scheduled commercial bank. Okay, because this is the mandate of the Reserve Bank of India, and the RBI is mandating the scheduled commercial bank to contribute in a fund. So if the RBI is mandating, so this will not be calculated in the exposure limit of the scheduled commercial bank. So large exposure framework in terms of which deposits maintained with the NABARD on account of shortfall in achievement of the priority sector lending target. So this is excluded from the exposure limit calculation. Now it has been said that this same guideline is expanded for the other funds also, or for the other institutions also, for the NHB, SEBI, Mudra also. Okay, so the same same exception is provided to the other institutions also. So in this connection, it is advised, the amendment has been done that in this connection, it is advised that in addition to NABARD, the above exemption that is provided to NABARD should also be provided to the NHB, SEBI, Mudra. So if the scheduled commercial bank is having the shortfall in the priority sector lending target, and the scheduled commercial bank is contributing to the fund of any of these entities, to the fund of NHB, SEBI, Mudra, etc. So now this contribution will not be calculated in the exposure limit of the scheduled commercial bank for that particular entity, so that the scheduled commercial bank has more leverage, has more space to do the exposure or to provide loans or to provide investment in these areas. Okay, so this is the idea. So here the above exemption shall also be applicable to the contribution made by the scheduled commercial bank to funds with NHB, SEBI, Mudra Limited or any other entity specified by the Reserve Bank of India on account of shortfall in achievement of targets for priority sector lending. So these contributions will not be included in the exposure limit, so that the scheduled commercial bank has more area to do exposure in each of these entities. Okay, so this is the idea. Now coming to the next and the last news article. On a review, RBI has decided to revise the qualifying asset. Okay, so basically जो banks होते हैं, अगर वो priority sector lending target को achieve नहीं कर पा रहे, तो उनको contribute करना पड़ता है किसी fund को, NABARD, NHB वगैरह की किसी भी fund को contribution देना पड़ता है जितना भी उनका target नहीं achieve हुआ, right? So अब जितना भी contribution वो दे रहे हैं किसी भी fund में, वो contribution exposure limit में count नहीं होगा उस एंटिटी के, ठीक है? तो मान लो कि सिंगल एंटिटी और सिंगल काउंटर पार्टी इज NHB and the scheduled commercial bank is contributing to the fund of the NHB, so that contribution will not be counted in the exposure limit. Okay, next is review of qualifying asset. See, now regional rural banks, they are constituted so that they can provide the funds in the rural areas, right? Similarly, the NBFC microfinance institutions, they have the particular motive of providing the microfinance, of providing the small loans. On a review, RBI has decided to revise the qualifying asset criteria for non-banking financial companies, microfinance institutions. So basically, it has been said that for the microfinance institutions, they have to give majority of loan to the small loans in the form of small loans, but there is the limit that has been changed that we have to understand. So first of all, here the microfinance institutions, they are working in the domain of microfinance. They have the priority to give the small loans and they should prioritize the small loans. Okay, now it has been said that the limit has been changed for the small loans that the microfinance institutions have to give. But before that, what is this small loans? What is the qualifying asset that we have to understand? So the definition of qualifying asset of NBFC microfinance institution has been aligned with the definition of microfinance loans. So qualifying asset of the microfinance institutions are those assets that are allowed for the, or that are have to be done for the microfinance institutions. So if you have a microfinance institution, if you are a microfinance institution, you have to give small loans. Now this small loans is the qualifying asset that has to be given by the microfinance institution. So the definition of the qualifying asset is aligned with the definition of microfinance loans. So how many of you know the definition of microfinance loans? So the definition of microfinance loans is that a microfinance loan is defined as a collateral free loan, no collateral, no security has to be given. You do not have to put your house as girvi as collateral, or you do not have to put your land as collateral, you do not have to put your jewelry as collateral. So there is no collateral that is required. Okay, so a microfinance loan, a small loan, is defined as a collateral free loan given to a household having annual household income up to 3 lakh only. For this purpose, the household shall mean an individual family unit consisting of husband, wife, their unmarried children. Okay, so this is the idea of the microfinance loan. And the qualifying asset, that means this is the asset that the microfinance institution should be this is the kind of loan that the microfinance institution should be giving, because the asset for the bank or the asset for the NBFC is the loan that the NBFC is giving or the bank is giving. So this is the asset on which the bank earn the interest. So qualifying asset or the qualifying loans of the microfinance institutions are those loans that have this definition. Okay, so the definition of qualifying asset for the microfinance institution has been aligned with the definition of microfinance loans. So this is the definition of qualifying asset. Before, the definition was different, but now the definition has been aligned with the microfinance loan. Now coming to the main idea, that qualifying asset of NBFC microfinance institution shall constitute a minimum of 60% of the total assets. That means out of the total asset of the NBFC microfinance institution, 60% should go, 60% of the total assets should go for the qualifying assets, that is the microfinance loans. You can understand. Got it? So this is the basic idea, that qualifying asset of the NBFC microfinance institution, that is the microfinance loans. The qualifying asset is the microfinance loan that should be 60%, minimum 60% of the total asset, netted off by intangible asset. That means in the total asset, just delete the intangible assets such as the trademark, the patent, the software system that the NBFC has, the goodwill that the NBFC has, the brand value that the NBFC has. So they are the intangible asset of the NBFC, the software, the patents, the trademarks, the brand value and such. So from the total asset of the NBFC, delete these intangible asset of the NBFC. So out of the total asset, 60% of the total asset should go to the qualifying asset, that is the microfinance loan. Okay. The Reserve Bank of India has revised the qualifying asset criteria for NBFs for the microfinance institutions, reducing the requirement from 75% of the total asset to a minimum of 60% of total asset. So the limit has been decreased from 75%. Before, 75% of the total asset had to be given in the form of microfinance loans. Now only 60% of total assets had to be given in the form of microfinance loans. Okay, so the qualifying asset norm was originally introduced in 2011, when the RBI created the microfinance institution category. So it was said that the microfinance institution have to give the small loans, that is the qualifying asset. That is the qualifying asset, setting the qualifying asset threshold at not less than 85% of net assets. At that time in 2011, the limit was 85%, or the minimum criteria was that 85%, that NBFC microfinance institution has to give 85% of the net assets in the form of the qualifying asset. Okay, so 85% of net assets should go to qualifying asset, and before the definition was around this, that the loan that is given should be given to the households with the annual income not exceeding 1,25,000 in rural areas and 2 lakh in urban areas. So the definition, previously the definition was different. Okay, now in March 2022, the RBI revised this definition to 75% of total assets. So 75, in 2022, the limit was decreased from 85% of net assets to 75% of total assets. This much has to be given in the form of qualifying asset. At that time itself, it was said that the qualifying asset will have the same definition as microfinance loans, which has been reiterated now, that qualifying asset compulsorily needs to have the definition of microfinance loans. Okay, so qualifying asset are actually the microfinance loans, you can understand. So now the definition has again been changed, the limit has again been changed to 60%, from 75% of total assets to 60% of total asset. Okay, so this is the idea. So here the two things that you have to remember, that the definition of the qualifying asset of the microfinance institution has been aligned with the डेफिनेशन ऑफ माइक्रो फाइनेंस लोन्स. सो अब जो माइक्रो फाइनेंस लोन्स की डेफिनेशन है वो ही डेफिनेशन क्वालिफाइंग असेट की है कि अगर एनुअल इनकम 3 लाख से नीचे होगी तो कोलेटरल फ्री लोन मिल सकता है हाउस होल्ड को. ठीक है. So the definition of qualifying asset of the microfinance institution has been aligned with the definition of microfinance loans, that is the collateral free loan given to household having annual household income up to 3 lakh. As well as the other change is that before the qualifying asset, before from the total assets, 75% of the total asset had to be given for the qualifying asset by the microfinance institution, that is for the microfinance loans. But now out of the total asset, 60% of total asset has to be given to in the form of microfinance loans, that is the qualifying asset. So limit has been decreased from 75% of the total asset to 60% of the total asset. Okay, this is the idea. Now under the earlier guidelines and total, now what has been said that the NBFC, that is not the NBFC microfinance institution, they can provide 25% of their total assets to the microfinance loans. Okay, so the NBFC other than the microfinance institutions, they can now provide 25% of their total asset to the microfinance loans. So basically the NBFC that are not microfinance institutions, so the other type of NBFCs, they can provide 25% of their total assets only up to, this is the maximum up to, this is maximum up to 25% of the total asset to the microfinance loans. Okay, so remember that this is the minimum limit that the microfinance institutions need to have the minimum of 60% of total assets in the form of qualified asset, that is the microfinance loans. And in the case of the other NBFCs that are not the microfinance institutions, they can have maximum up to 25% of the total asset in the microfinance loans, not more than that. Any confusion, anyone? Any confusion? Now I will give you the questions. So before starting with the questions, so this is the Perspective 360-degree series where the answer writing practice you can do, and many of the students, they are not good in answer writing. So here Jaskaran sir takes the session on Monday, Wednesday and Friday at 5 p.m. Okay, Monday, Wednesday and Friday at 5 p.m. where he tells you the art of writing the answer, as well as he gives you the questions from the current topic and the relevant answers from the current topic, so that you know that which topics are in news from which the descriptive question can come. And this is a very important session for your answer writing practice. Now coming to the first question, I hope you will be able to answer this question where you have to tell the exposure limit for the urban cooperative bank. Okay, now the next one is in regards to large exposure and the meaning, the definition of large exposure that you have to inform. The last one is in regards to microfinance institutions. So the qualifying asset of microfinance institution shall constitute a minimum of what percentage of the total assets, the new definition, as well as see, there is one more point. See, if the, let's say this is the minimum of 60% of total asset that the microfinance institutions have to achieve. Now, if they are not able to achieve the minimum of 60%, if they are only achieving 50% or 45%, so in this case, if this is happening for 4 consecutive quarters means that for 1 year, 4 consecutive quarters means in 1 quarter there are 3 months. So in 4 consecutive quarters means that in 12 consecutive months, if they are not able to achieve the minimum of 60% of the total assets in the form of qualifying asset, then in this case the microfinance institution has to give a remediation plan to the Reserve Bank of India, that how the microfinance institution is going to resolve this kind of situation, what is the remedial plan, or how the remedy is going to happen. Okay, so the microfinance institutions need to provide 60% of the total asset, minimum 60% of the total asset in the form of qualifying asset in the form of microfinance loans. And if they are not able to achieve this target, if they are not able to achieve this minimum criteria, then they will have to, and this is not achieved for 4 consecutive quarters, that is for 12 consecutive months, then they will need to have the remedial plan given to the Reserve Bank of India. Okay, so this is the question. Now you will be able to easily answer this question, very easy. So this is it. Thank you very much for joining the session. If there is any confusion, any problem you have, you can write it in the comment section below. And the video was lagging, so I was repeating some of the points so that you can understand even if there is the lag that happens. Okay, so this is it. Thank you very much. Thank you for joining.